Welcome to the deep dive. Today, we're not talking about, slow growth or minor tweaks. We're going straight into a strategy that lets serious commercial real estate investors acquire massive assets, especially when traditional bank financing has basically just slammed the door shut. We are diving deep into the structure, the risks, and all the protections of the Master Lease-Option, or MLO.
And that door slamming shut that's the critical context here. You really need to understand the market pressure. We are tracking over $1.9 trillion in commercial loans, trillion with a T, and they're all set to mature in the next few years.
Wow. So when these loans come due, what happens?
Well, lenders are forcing hands. They're demanding huge equity infusions, think 35 to 45% down, and they require stellar credit profiles on top of that.
Which just leaves most people completely on the sidelines.
Exactly. Stuck.
So that dynamic, that's what's created this massive opening for the creative investor. Our mission today is to unpack this MLO strategy. It's the mechanism that allows buyers to control huge commercial properties using little, sometimes no personal capital up front. And we're focusing specifically on the playbook being used by investors targeting those high-growth areas around Indianapolis, places like Carmel, Fishers, Noblesville.
And it's no surprise that this MLO strategy is, it's often cited as the single most requested item from any creative financing series. It directly attacks that capital crunch. It bridges the gap between a motivated seller who just wants cash flow and a capable buyer who can execute a plan but, lacks that massive down payment.
Okay, so let's unpack the core mechanism here. We need to get past the acronym and really look at the financial engineering. The investor's goal isn't just to be a tenant, right? The real goal is to force appreciation over the lease term.
That's it. So the eventual purchase is a total slam dunk, and that's where the term length comes in. The master lease term is set long enough, usually 7 to 12 years, to give you a clear runway. A runway to implement serious value-add strategies, increasing occupancy, renovating, streamlining ops, all of it.
And here's the part that I find most interesting, the financial component of the rent itself.
Yeah.
The master rent. The investor agrees to pay the seller rent that's only 92 to 97% of the property's current net operating income, the NOI. So if I'm a seller, I'm literally leaving money on the table. Why would I ever accept a discount like that?
That's the question we have to hit head on. If the seller can net, say, $100,000 in NOI, why take 95? The answer is guaranteed passive income and the elimination of all daily management. We call it zero headaches. A lot of these sellers are older. Maybe they're looking toward retirement or they're just completely burnt out. They value that long-term, predictable check more than they value chasing the last 3% of income through active management.
So we're solving a quality of life problem for the seller. It's not purely a financial one.
Exactly. The structure makes the seller, in essence, a passive lender on their own asset.
And that small discount, that 3 to 8%, is what creates the investor's immediate profit.
Yep. The investor immediately creates a positive spread, an arbitrage, right from day one. And that spread, which could be anywhere from $8,000 to, say, $45,000 a month, that's crucial. It's what pays for your immediate operating costs, a contingency for CapEx, and your own profit margin. You're paying for control and stability.
Okay, let's shift to the option side of the deal, because that's where you lock in the monumental upside.
Mm-hmm.
How is the option strike price actually figured out?
The strike price is absolutely fundamental. It's typically set at the property's current appraised value, so today's value, plus a small fixed annual escalator, maybe 3–4% a year. And this is the key. You are fixing the price of the asset based on its current kind of mediocre performance, even though your entire plan is to dramatically improve that performance.
So if I'm the investor and I execute my business plan flawlessly, I'm buying the property in 10 years at a price that was dictated by, 2024 numbers?
Precisely. And by the time you're ready to exercise that option, you've successfully grown the NOI and created a way more valuable asset. And that increased performance, that's what the banks want to see. When you go for your exit financing, lenders are so much more comfortable offering high loan-to-value ratios, 75, maybe even 90%, because they are lending against the new reality you created, not the dusty old financials from a decade ago.
This is where the math just gets staggering. Let's make this real with the example from the playbook. Imagine a $10 million commercial property. Its current NOI is, $750,000?
Okay. So the investor structures the MLO. They agree to pay the seller $690,000 a year in rent. So right away, they're pocketing a $60,000 annual spread. Their plan is aggressive. They want to boost that NOI from $750K all the way up to $1.35 million through smart improvements and better leasing.
And if they hit that target NOI, that 1.35 million, assuming cap rates stay stable, the property's value could just explode to around $22 million.
It's a massive jump. But here's the magic. Because the option strike price was set at $10 million plus, say 4% escalators over 8 years, the investor exercises their option at approximately $13.6 million.
Wait, let me just repeat that for you listening. They get to buy an asset that's now valued at $22 million for $13.6 million. That is over $8 million in equity created, with almost no money down at the start. It just shows the insane power of time and forced appreciation.
It's the ultimate example of using strategic control to achieve just monumental scale.
Okay, moving on. The MLO is not a one-size-fits-all solution. Depending on the asset's health, you need to pick the right strategy. The playbook lays out 4 distinct flavors of MLO.
That's right. You have to match the structure to the asset. You don't want to use a heavy value add approach on an already pristine building. It just wouldn't make sense.
So let's start with the simplest one, the pure cash flow MLO.
This is for your stable, high-occupancy assets. Think 95% occupied or better. The strategy here is simple arbitrage. You're just capturing that 3 to 8% NOI spread, potentially forever. You're basically a passive master tenant, collecting the difference between what your subtenants pay and what you pay the owner. Low effort, very predictable income.
Okay, next up is the fan favorite, the value-add MLO. This seems to be the one for massive equity creation, but it has to be riskier, right?
It is riskier, no doubt, but the reward is so much higher. You're specifically targeting assets that are, say, 60 to 85% occupied. These are assets that are broken, mismanaged, or just desperate for CapEx. This flavor is designed to maximize that forced appreciation we just talked about.
So when does a value-add deal get too risky? I mean, if a building is only 50% occupied, is that just too low to make the numbers work at the start?
Often, yes. If the occupancy is too low, you risk just burning through all of your cash reserves before your stabilization plan can actually take hold. That 60 to 85% sweet spot means you have enough immediate cash flow to cover the bills while still leaving massive room for improvement.
Got it. Now for the more complex structure, the sandwich MLO. So the investor master leases, and then they submaster lease it to an operator. Explain that second layer for us.
Right. So the initial investor becomes the ultimate financial middleman. They pay the owner, say, 95% of NOI, and then they turn around and submaster lease the entire property to a specialized operator for, let's say, 98% of NOI. The investor captures this tiny, totally passive second spread, but the real prize is they have zero day-to-day management responsibilities.
But wait, if the initial investor is relying on some sub-operator to increase the NOI, how do they maintain any quality control? How do they make sure that forced appreciation strategy actually happens?
That's all addressed in the sublease agreement. The initial investor includes really strict performance metrics, CapEx requirements, and often performance bonuses for the sub-operator that are tied directly to NOI growth. So the original investor keeps strategic oversight, but delegates all the tactical day-to-day execution.
And finally, the fourth one, the hybrid MLO plus assumable debt.
This one is just elegant. It pairs the MLO structure with an asset that already has existing non-recourse debt. Ideally, you find a low-rate loan from years ago that can be assumed. This instantly eliminates the problem of today's high interest rates, and it just supercharges the deal's immediate cash flow.
Okay, speaking of protection, these creative deals, they've got to require airtight legal frameworks. We should transition to the protective measures and the non-negotiable clauses that have to be in the MLO agreement.
Absolutely. The contract terms are where you mitigate all that operational risk over the next 7 or 12 years. Let's start with the huge one, the absolute triple net until exercise clause.
Okay, we hear triple net all the time. For anyone less familiar, what does a normal triple net lease even mean?
In a normal triple net, or NNN lease, the tenant pays for everything. Property taxes, insurance, and all the maintenance, including the big stuff like the roof or the structure. It's the highest level of pass-through to the tenant.
But with this MLO clause, we're actually flipping that around for the major items.
Yes. The absolute triple net until exercise is the investor's best friend. Even though it's a master lease, the seller, who is the landlord, maintains responsibility for the major structural items. The roof, the foundation, repaving the parking lot, all that stays with them until you actually buy the property. That shifts hundreds of thousands of dollars of potential liability away from you during that lease term.
That's a huge de-risking factor. Now, what about the truly non-negotiable term, the one that's been called the $1 million clause?
This is the CapEx credit language. I mean, if you're doing a value-add strategy, you are spending your own money to renovate and boost the NOI. This clause makes sure you get credit for every single dollar you spend.
Can you give us the specific wording the playbook says you have to have?
Yes, it must state, and this is critical, that all documented capital expenditures over $5,000 shall be credited dollar for dollar against the option and purchase price at closing.
Yeah.
So if you spend $500,000 fixing the place up to justify that new $22 million valuation, you immediately get to reduce your $13.6 million strike price by that $500,000. It turns your expenses directly into equity.
That is the ultimate incentive for a renovation. Okay, what about securing the deal itself? How do you make sure the seller can't just find a better offer in year 5 and kick you out?
Security is paramount. You need 2 legal handcuffs. First, on day 1, you record a memorandum of option. This is a public document recorded against the title that tells the whole world you have a legal right to buy that property. Second, if the seller has an existing loan, you have to get a non-disturbance agreement from their lender.
And what exactly does that non-disturbance protect you from?
It makes sure that if the seller defaults on their own mortgage, which could absolutely happen in this rate environment, the lender cannot terminate your master lease or your option. Your right to control and eventually buy the asset is safe, no matter what happens with the seller's finances.
And finally, protecting the investor's own personal wealth right from the start.
Yes, we always push for the guarantee burn-off. While a seller might require a personal guarantee on the lease, the agreement must have language ensuring that it's either limited to a certain amount or, ideally, it burns off completely after 12 to 24 months of perfect performance.
So that's the legal framework. But before we even get there, we need the financial fail-safe. The crucial 11-point underwriting checklist. This is how you make sure the deal actually works even under stress. What are some of the key numerical requirements?
This checklist is ruthless, and it has to be. It's designed to weed out deals that look good on paper but crumble under pressure. First, immediate cash flow. Non-negotiable. You have to ensure that the guaranteed year-one positive spread is at least $30,000 to $40,000 total minimum. No hoping. The deal must cash flow immediately.
And now, for the critical stress tests, the market is volatile.
We have to stress test the cash flow against a double negative scenario. The property must still cash flow even if you simulate a 20% drop in occupancy and a 15% drop in rents at the same time. If it fails that extreme test, the deal is just too fragile. You walk away.
That is a tough test, but necessary. What about the safety buffer for when you project the option exercise down the road?
You need a serious margin of safety. Against cap rate shifts or unexpected costs, the checklist requires that your projected value at exercise has to be equal to the strike price plus a 30% safety buffer. So if your strike price is $10 million, you want the property to appraise for at least $13 million when you buy it. That 30% is your insulation.
And the final check, making sure you can actually handle the new debt when you exercise the option.
Absolutely essential. Before you sign anything, you have to confirm that the worst-case projected debt service coverage ratio, the DSCR, will be a minimum of 1.25.
And what does that 1.25x actually tell a lender in practical terms?
It tells them that for every dollar you'll owe in mortgage payments, the property is generating $1.25 in net operating income. It's proof that the property can easily sustain the new debt, which is crucial for getting that high LTV financing in 8 years.
This level of underwriting really shows that the MLO isn't some high-risk gamble. It's a strategically secured acquisition tool. Now let's look at some real-life applications. Give us 2 quick examples of these structures in action.
Okay, the first is a classic value-add multifamily example. It was an 80-unit apartment complex in the Indianapolis area with a seller who was retiring. They structured a 10-year MLO, paying 94% of NOI, and they made sure to get those full CapEx credits. The investor just focused on quick unit renovations and cutting utility costs.
And what was the result of those specific moves?
The forced appreciation was massive. They grew the property's NOI by 28% in just 26 months. That growth just exponentially increased the value against that fixed option price, creating instant equity on paper, exactly like the model says it should.
Okay, and the second example, the one that shows the power of the hybrid approach.
That was the medical office hybrid. This deal was for a suburban medical complex. Critically, it had an assumable 4.1% loan still in place. By combining the MLO structure with assuming that old, low-rate debt, they completely sidestepped the current 7% rate market.
That sounds like it would be a lightning-fast deal.
It was. They closed in 38 days. A standard commercial loan package would take months, and the property immediately started cash flowing 6 figures annually just because the debt service was so incredibly low. It just shows the power of pairing these two strategies together.
I want to circle back to something you said earlier, a really critical concept, the motivation of the seller. You said the success of this hinges on the seller having a low basis. We need to define that clearly for everyone listening.
Yeah, the seller's low basis is crucial. It just means the seller bought the property a long, long time ago, probably for a low price, and they have very little or no debt left on it.
But why does that low basis automatically equal motivation?
Because if they sell the property outright today for its market price, they're going to face a massive capital gains tax bill on the entire profit. But by using the MLO, they get guaranteed long-term passive income, and they might be able to structure the eventual sale differently for tax purposes. They aren't as worried about squeezing out the last dollar on the purchase price because their cost basis is so low. They're motivated by security, tax planning, and, well, avoiding those daily headaches.
This regional focus on Indianapolis and its suburbs, it really anchors this. It shows it's an actionable, real-world strategy, not just some theory.
Exactly. The action plan for an investor in that market is clear. You study these protective clauses, you identify target properties, and you run that rigorous 11-point checklist. If it passes, you submit your LOI and you close.
So what does this all mean for the future of commercial real estate buying? The main lesson here seems undeniably clear. The investors who are going to dominate the 2026 and 2027 market, they won't necessarily be the ones with the biggest bank accounts. They will be the ones who have mastered the most protective, the most creative, and the most rigorously underwritten strategies, like the MLO.
That's the entire takeaway. The MLO works. It works because it bypasses the bank's 40% down payment problem for the buyer, and it solves the tax and management problem for a motivated seller. And like we said, the seller's low basis is the starting point for finding that motivation.
And that leads us to our final provocative thought for you to consider. Given that the seller's low basis is the critical factor for their participation, how drastically will that $1.9 trillion in maturing commercial debt that is often underwater or priced at painfully high rates, how will that shift the very definition of seller motivation in the coming years? What other non-monetary incentives beyond just guaranteed rent could be built into these leases to secure a seller's participation, even if their basis isn't low and they have huge debt coming due?
That new definition of motivation, that might just be the key to the next wave of these deals.
A truly fascinating dynamic to watch unfold. Thank you for joining us for this deep dive into the Master Lease-Option strategy. We'll catch you next time.